Loan Tech is going to help you convert your online leads, guys. And they do so much more than that. And it's free for 6 months. Listen, give it a shot. What's there to lose? If you haven't done it, check it out, give it an honest shot. All it could do is help your business. Nothing can hurt from you clicking this banner right over there. And just follow up, check it out, kick the tires of it. If you're on Facebook, you can get there up above. Don't miss out. So there sure does seem to be a mad dash push from Washington to open up credit now, doesn't there? So every change Fannie Mae just made is intended to lower standards for qualification. That's what it really all distills down to. Take the alimony off the income, not the debt. It dilutes the impact on your ratios, doesn't it? Don't worry about that payment on the house you own if you've got 12 months canceled checks. Are you kidding me? Oh, and by the way, you don't have to use that student loan debt if there's nothing shown on the credit report. Really? Is this all prudent? And oh, by the way, we're going to expand to 50 back-end ratios. Now, are these the type of changes trying to stave off another mini bubble? Because these moves, to me, seem desperate.
Folks are already having a hard time qualifying for homes, and Alan Greenspan just came out and said, don't worry about stocks, but watch the bond bubble. I mean, what would happen to housing at its current inflated value if interest rates went up by 2%?
Now, we've said for the last couple of years, eventually we're going to get to a point where one of three things needs to happen. One, folks need to get pay raises in a real big way. Not gonna happen. Two, new and loose products need to enter the market. Or three, we have to loosen up our guidelines. And if one of these three things don't hit, house values are going to retreat. Just how much depends on the three variables that I just mentioned. If there's no pay raises, no new products, and underwriting remains the same, this whole thing could be bad.
Well, we know nobody's getting pay raises in a big way. New products? Well, lenders are too scared to use them. Thanks, CFPB. The next bubble? That's on you. Yet, now we see the GSE scrambling to mitigate any mini bubble by making some daring changes to guidelines. And with that in mind, now there's more from Washington.
Currently, we have bipartisan. When was the last time you heard that anything in Washington was bipartisan? There's bipartisan support for Fannie Mae and Freddie Mac to use alternative credit scoring models. This is interesting, and let's think of the unintended consequences, shall we?
The bill would direct Fannie and Freddie to create procedures that would allow them to consider credit scores other than the traditional FICO score when making the decision to purchase a loan. Such a change would allow lenders to use alternative credit scores such as the VantageScore or FICO Score XD when determining whether consumers are fit to receive a loan.
Now, as you can imagine, VantageScore is thrilled about this whole thing. Of course they are. They say no company should have a monopoly on credit scores in housing. Oh, really? Are you sure about that? Because VantageScore goes on to say, allowing each lender to choose the credit scoring model best for its business is in the short and long-term best interest of the housing finance industry and the consumers they serve.
So what's the best? Well, what's the best? The best is the scoring model that gets your client into the loan, right? The best is the highest scored model as far as a loan officer is concerned. Now think of this. The highest scored credit model is going to be the worst credit report from a lender's perspective, right? Not a loan officer or a borrower, but a lender's perspective. Lenders are looking for the worst case scenario, not the best. Lenders want to know how it can go wrong, not how it can go right. Yet under the proposal from Congress, they're now going to allow competition where the lender picks the rosier credit report.
And is that good? For who? And further, let's think of the rating agencies in the build-up to the market crash. It went something like this. You, rate these bonds right now. Rate them AAA. Oh, what? You're not going to? Then I'm going to go over to this guy and he's going to rate them AAA. You see, rating agencies are basically credit scoring companies. And they had a race to the bottom to score as much AAA as possible to pick up market share. And in the end, the quality of the ratings suffered.
Ask yourself, if loan officers are giving the choice of credit score great or credit score good to get a loan approved, what are they going to take? And further ask yourself, human nature, If credit scoring companies know that lower standards mean more business and money, how will they approach their scoring? This is inevitable.
Yet Congress, in its attempt to right the wrongs of policies passed, may have created yet another problem in their attempt to fix things.
What do you think?
I think competition on credit scoring models, something that's subjective because you can tweak your algorithm, is not necessarily a good thing. The more I lower my standards, the more business I get. It's going to benefit me because loan officers and companies who sell these loans off, it's going to benefit them. It's a race to the bottom.
Could very well be, man. It's amazing what happens when things get a little tight.
Oh, exactly. We saw it with Fannie Mae. We're seeing this time and time again. Right now, Washington is looking at the future of housing, and they're saying, oh my God, we can't afford another mini bubble. What can we do? Since we've basically shut everybody else off from trying to correct this, now let's put it on the shoulders of the federal government. Awesome!
Wow, man. Let us know your thoughts on all this down below. We always appreciate your comments. You guys have a great day today. Favor, forward, share, and subscribe for free in your upper right-hand corner. We'll catch you guys later on Monday here at the National Real Estate Post.
If they have alternative credit scoring models, they need to keep it with one company, and then they can objectively look at what those changes are, because some need to be made so we can allow borrowers in, responsible borrowers in, but creating competition lowers standards. That's it.
There you go. See ya.
Bye.